let's get started. A little bit of a different kind of agenda here, but similar topics, just maybe constructed a little bit differently. Spending a little bit less time on some of these macro items that we touch on, because these are the bigger picture items that don't tend to change really quickly, but when they do, they're important to notice. And then looking at the 24 outlook, we did a little bit of a preview of this on our last Market Matters in December. But now that year end is closed out, we've got maybe some additional ideas. And then really what we're thinking around things like stocks and bonds, but also more in the news right now, things like digital assets that have grabbed some media attention, because some of you all have asked us about it. So probably worth a few minutes to spend on that. So let's get started. Again, this is like probably one of the charts we come back to, because it does give a good sense of where the economy has come from, and then trends that maybe you can extrapolate along the way. And what you see here is a picture of both the services sector in the US in purple line and the manufacturing sector in the orange line. And just to reiterate, any number above 50 indicates growth in that segment. And you can see just a couple of things stand out. Really, since the beginning of 23 and into 24, the services sector has been pretty well established in expansion territory for the majority of that time frame. Pretty flattish trend. However, manufacturing is making appears to be a bit of a turn or bottoming. You can see that coming through here from January, bottoming in July, and now looks like it's starting to resume on the uptrend. And that's really positive, because if services can stay flattish to where they are right now, and a resurgence occurs in the manufacturing sector, then I think that's how you can see some accelerated growth that maybe the market could be pricing in at some point later in the year. So from an economic standpoint, the foundation appears to be pretty solid, but nothing too significant at the moment. None of the big swings that we saw like in 21 and 22. Commodities, however, are telling a little bit of a different story. This is a picture starting in January 1, going through the end. Actually, this is through January 8th, so yesterday. And a couple of things stand out here. One is, if an economy is growing pretty rapidly, then commodity demand by extension would likely be the case, and in which case an upsurge in demand on steady supply would lead to higher prices. And what's not been occurring, as you can see in the chart here, is both on the industrial metals side, which is that orange line, and the energy side, the purple line. Energy and metals prices have been actually trending lower since the beginning of 23, with a lot of volatility along the way. And if we really were in an upswing in economic activity, you would expect some of those sectors to be responding to that. So that's something we're keeping an eye on, because if these commodity prices don't respond, then what we could be seeing in front of us would just be potentially a false positive. One other item to just note here: ag price has been very stable, so nothing really to make of that per se. Might even lend itself to downward forces within inflation on all three of these. But the precious metals sector, this is the green line here. We don't talk about gold or silver or precious metals too often, but I think the fact that we've had a very volatile rate environment, a really volatile equity environment, and yet a very stable price regime for precious metals may indicate, and there's some widely documented reporting on this, that there's been a lot of interest in buying in precious metals out of Eastern Asia, particularly China and some of those areas that are trying to diversify away from the dollar. That's propping up some of these prices. And I think that's just an item that is worth noting, because if it was a full risk-on environment, then gold would likely be selling off, because it's not necessarily a risk-on asset. It's more of a stable value asset. And the final, just kind of macro chart we wanted to just touch on. We touched on it last month, and this is just a really important chart to keep track of inflation, because inflation influences what bond prices will do, or actually what the Fed will do, which by extension will influence what the bond prices will do. And what you can see here is we've got a number of different things going on within inflation, but after peaking in 21 into 22, come right back down, so almost a full round trip. But instead of landing at the lower point that inflation was starting 21 out, we do appear to be stabilizing in a higher range, which has been our kind of thought all along, between roughly 3 to 4% inflation, which is different from the 1 to 2% inflation decade we just came from. And so we think that actually has implications. Number one, on the prices that we should pay for financial assets, but number two is volatility in the market will likely be higher if there's generally higher inflation. So market calendars for this Thursday, because Thursday is when the December consumer price index comes out, and if there's any real upside to that number that the market isn't expecting, we could be seeing a pretty negative environment for risk assets here in the not too distant future. But that's not our central tendency, but it's definitely something we're watching out for. And we'll touch on that here in just a moment. So here are our core themes that we introduced in December that we'll just cover again here in January. Number one is, I think there's still quite a bit of waiting to see what happens after 2 very negative years of bond returns, almost a third in 23. Actually, bond market would have been negative were it not for the very sharp reversal in yields in November of this past year. But the fact that bond yields, and in some cases the 30-year bond, went down as fast as they did, created a lot of knock-on effects that, in our opinion, just haven't necessarily worked their way through the system yet. Kind of like some of the stimulus. So we're being very mindful of positions we're taking within the bond market, just to be careful of some of these knock-on effects that have yet to possibly occur. The recession that was supposed to be so well telegraphed in 23 never really happened. It is a possibility now, and Fed would certainly indicate as well too, that we're in for a shallow, soft landing, if you will, is what it's being called. It is quite possible that is the case with all the stimulus approaching still. But that's, again, nothing we can really rely too heavily upon. So our perspective here is to remain neutral on any positionings within our asset allocation, because in the absence of any strong views, neutral should be our central tendency. The other two here, I think, are the key points from this presentation. One is that we are entering an election year, not just in the US, but actually globally. There's a number of different very meaningful elections that are set to occur in 24. I think the UK has a prime minister election coming up. India has a prime minister election coming up. And of course, US has a presidential election coming up. But it's important to recognize that politics does not equal financial market stability or fragility. Yes, there are policies that can change the trajectory of financial markets, but very rare is it the case that they are the reason that one can point to as to why a market is up or down. Because at the end of the day, markets respond to earnings. And if earnings are still robust, then there's really no reason for a massive sell-off to occur if one party gets elected or another. And then the other one I would just want to point out here is that the Fed did have a very important press conference during December, after we had Market Matters, indicating that they would be looking to potentially cut interest rates up to 3 times in 2024. That is very different expectations. We'll show you that in a moment, of what the market is expecting. And when you have such a wide variance of what the Fed is saying versus what the market's saying, then I think that can just lead to some disappointment when expectations aren't met. So we'll tell you how we're addressing that. Just a brief look at where we're positioned now versus Q4, and what this chart says is we haven't made really any major positioning adjustments since the end of Q4, or Q4 in general. We did do some model readjustments. We're getting more index oriented in some portfolios. In our active equity strategy, we did make some positioning changes, rotating a little bit out of technology and into things like healthcare and materials, beating down sectors from last year. But that's really the vast majority. And then on the fixed income side, we added just a small amount of duration to our portfolio, primarily in investment grade bonds. We still don't have much, if any, exposure to emerging market debt or high yield bonds. We think that's you're just not getting paid enough to take those types of risks. And as far as liquid alternatives or private alternatives, our positionings remain relatively well established there. And actually, there's opportunities on the private side in particular. are getting quite a bit more attractive. So let's take a look at 22 into 23. And I just thought it was useful to point out that this is a picture starting in January 1 through January 5th of 2024. So January 1 of 22. Market has basically made a full round trip in the S&P. EFA index, same way. Developed market stocks have really gone nowhere over the past 2 years, even though it may feel like we've had quite a bit of movement, which we have. Markets have fully recovered. And the unfortunate thing about where we are right now is that now that we've fully recovered, earnings haven't necessarily grown fast enough to deal with what we've perceived to be as a bit of a valuation issue within the stock market, at least in the US side. Emerging markets still are the broad categorization or broad category that has a hard time getting out of their own way. With a strong dollar, it's just very difficult for EM stocks to be perceived as very attractive relative to what we could be investing in. A lot of that underperformance is still driven by China, with banks now actually going into receivership in China, property companies in China having significant issues, Evergrande being and Country Garden being the two main ones there. We just feel that the risk reward is still not in place for emerging market stocks and Chinese stocks in particular. So that's really a little bit about kind of where we come from. But we will get Q4 earnings here shortly, and that'll give us a good picture of what's to come in 24 and how earnings evolved. We showed this chart last time, and I think it's a really important one to keep an eye on because variations from a mean are worth looking at, particularly when they get to extreme levels. And what you see in the chart here is the difference in returns ratio of the Russell 2000, which is the small cap index, versus the S&P 500. And so what this means is if the bar line is going up, that means small cap stocks are outperforming. So you can see basically from 99 all the way through 2014, small cap stocks outperform the S&P, believe it or not. And then really starting in 2014 through current day today, the S&P has been dominating small cap companies and in not a small way either. It's been a very large difference in performance. So these differences in performance are just things we want to pay attention to. And this led us to our initial idea that we needed to start adding not necessarily small cap, but more mid cap companies back to our portfolio. So we started doing that at the middle to end of last year. Haven't made any additional adjustments to this point because the ratio hasn't really changed a whole lot, but still this is something that we'll be looking to potentially add to as far as mid-cap exposure if the ratio gets a lot worse from here, which maybe it will, maybe it won't, but we'll be very mindful to take those opportunities as we're presented them. Particularly if things like large cap growth continue to outperform and valuation gets more expensive. So we are about to enter a Fed easing cycle. As the Fed is clearly communicating they have a bias to cut rates. We'll see if that actually happens. That could just be, a lot of talk, and I hate to put too much emphasis around what the Fed is saying because actions versus words are very different sometimes. But this is, I think, a really useful chart to understand what are the range of outcomes in a scenario where when there is a recession, that's the price performance of the S&P from the time the Fed starts cutting rates and then the months after, and the economy enters a recession. So down, call it 15% 1 year later from the start of the Fed rate cut to all other periods where the market is higher by 10%. So, whether or not we hit a recession in 23 is actually going to be really instructive as to what direction we go. But, all the data we're looking at the moment still suggests that a recession is quite a bit of a ways off and no real need to get too concerned about that at the moment. Like I said, we're going to see starting this Thursday with JP Morgan kicking off Q4 earnings season. That's going to give us a really good look and outlooks, more importantly, as to what companies are seeing in 24. This is just what we were talking about. A little bit of euphoria kind of crept into the market in Q4. And what you're seeing is a picture of S&P earnings here in the dark blue line. This is the left-hand side of earnings the S&P was expected to earn. And then, of course, the right-hand side axis is the S&P level, so with the dashed blue line. So what you can see is as Q4 earnings began to be adjusted lower over basically the whole course of Q4, the S&P kind of ignored that and made almost new highs as we exited 2023. And this just sets up, again, for high levels of expectation, because now the multiple on the PE multiple on the S&P is high. And if these earnings that have been actually, in fairness, been lowered already, if they don't come in at this level and come in lower than that, then there could be some pretty sharp downside from the S&P level from where it is today versus, maybe what the market is expecting or what investors are expecting. So our way of handling this is to make adjustments to our portfolio as we receive, what we perceive to be above average prices. So, one way we reflected that is with some of the single stock positions that we've made adjustments to. We've trimmed back a number of tech companies, NVIDIA being the example there, the prime suspect there. We trimmed back NVIDIA. It's still a top 5 holding in our equity strategy, single stock strategy, but we trimmed it back 3 times last year. And added to more undervalued names. So it's that process of regularly finding new opportunities that are undervalued and trimming back overvalued opportunities, I think is which is part of our process. One question here, which is a great question, is are you concerned with the tech elites skewing the metrics of the overall S&P? Yeah, so it gets to the Magnificent Seven discussion versus the other 493. Yeah, I think that's definitely a area of concern for us, absolutely, particularly at the index level, which is why index strategies right now, while appropriate and suitable, may have some challenging times ahead if the leadership in the Magnificent Seven becomes under pressure and earnings don't show up to the degree that the market expects. So, again, in our single stock strategy, we don't have a full exposure to the Magnificent Seven, quite the contrary, actually, and yet maintain an S&P-like return profile last year. So we're pretty pleased with how we're positioning, and we think this is why looking at other parts of the market now, so things like healthcare, industrials, material sectors that have been really beaten up are probably worth looking at again. So just looking at bonds now, just for a quick minute. This is a picture of 2023 and how it evolved. So as I mentioned, up until, call it late November, most of the bond indexes were actually lower for the year, with the exception of high yield. High yield had a stellar year last year. And as I mentioned, we had no real exposure to it, but high yield is really more of a kind of an equity proxy than it is really a debt instrument because of the volatility and how it correlates with stocks. But you can see at one point the long bond, this is the 30-year TLT, was actually down 15%, which would have been on the back of a year like in 22, which saw that TLT down 33%, and the year before that it was down single digits. So looking at just epic amounts of loss in the long bonds, which as you all may be aware, we have no exposure to long bonds, but just the volatility of this position and volatility of interest rates, I think, as we'll show in the next slides, just tells it's still very much up in question. And if that's the case, it's likely better suited to be more conservative, because remember, short-term bonds right now are still yielding more than longer-term bonds. So in that way, we're getting paid to wait a little bit without taking on a whole lot of risk. This is, I had to check this chart probably 4 times to make sure that I was looking at the same number. But what you're seeing here is the 10-year bond yield from January 1st to the first actually trading day of 24, which was January 5th, I believe it was, or whenever the 5th was. Let me just make sure my calendar scheme is right here. Oh, I'm sorry, to the 5th. So one thing to note, actually January 1st, it was the same yield as well too, was that the bond market, or at least the yield, did a full round trip after troughing at 3.5% early in the year in the wake of Silicon Valley, peaking at roughly 5%. You may recall that in mid to late October, and then yields went on a tear all the way down. They ended in the exact same spot as they started the year off. So this is the type of volatility that we had been anticipating and foreseeing. So while our strategy did outperform the aggregate bond index, our thought all along has just been, well, why would we take on this type of volatility if we didn't need to? And I think that was the right answer. We still think this is very much a possibility, these types of moves in the foreseeable future, particularly as we approach election year, Fed policy changes, things of that nature. One other thing I just wanted to point out here is this is now the full look at where yields have come from since January 1st, 2022 to the end of the year in 2023. And you can see here we come quite a long way from, call it 1.5% in January 1st of 22, ending the year at 3.88, 3.99, somewhere in that neighborhood. And that's a lot of ground that has been covered. This is just something what we're saying, when rates rise this fast over a relatively short time period, things can tend to break. Just takes a little bit of time for them to happen. Just think Silicon Valley Bank, but maybe other types of assets. And so there's a big expectation right now that the Fed is going to pivot, as we'll show in the next chart, to a cutting methodology. And we think that's just a really, big assumption to make at this point. This is just a chart of volatility. I've never really used this chart before, but I think it is kind of useful to give you a frame of reference for bond volatility. So this is why what we're saying here is, a rising level of bond prices, this is the price volatility, tends to indicate, troubled times on the horizon. So very similar to the way, the VIX index, a rising volatility index for the stock market, can indicate future trouble on the near-term horizon. Bond volatility does appear to have leveled up since the post-COVID era into a higher range. And when bonds are just as volatile as a steady state, it means you have to be very careful where you step. This is actually the ICE BML move index. So it's an actual index that measures bond volatility. So when bonds are this volatile, it's better to stay relatively conservative, particularly if you don't need to take the risk, which at this point, we don't believe we do. And then this is I think the key chart for 24, where where a lot of money will be made and or lost is, and let me just kind of run through this here to give you a sense of what I'm talking about. So this yellow line here, or I guess it's more orangish, is the summary, it's the Fed dot plot, essentially. So every few months or so, all of the Fed governors get together and they ask each other, okay, where do you think the Fed funds rate's going to be in 3 months, 6 months, 9 months, 12 months? And then they make their, tally, and then it's tabulated by the Fed. And they publish this chart that looks, not like this, but it shows all the dots of where the individual people voted. And so what the governors are suggesting right now is that starting in April, after April and into May, the Fed may start cutting interest rates by 25 basis points at successive meetings for a total of roughly 3 interest rate cuts over the course of 24. And this is as of January 4th. This dot plot hasn't changed. But what has changed a little bit since the end of the year and into the first week of the year, and potentially why markets are selling off a little bit here more recently, is that you may have noticed bond yields have been rising a little bit, particularly the 10-year, which ended the year again at 388 or 390-ish, somewhere in that neighborhood, is now about 4% again. And what this is inferring is that market participants actually think the Fed's going to be much more aggressively cutting interest rates than what they're telling us. And there's a lot of people reading into these tea leaves, I think, a little too hard, because what I always am reminded of, and was talking to one of my friends about this yesterday, that is pretty involved in markets as well, is that these future curves, and these are the Fed SOFR future curve. It's a proxy for the Fed funds rate. All this curve is telling us right now is the price at which any holder of these contracts is willing to, clear it at certain points along the way. It's not necessarily too great as a predictive mechanism, but a lot of investors, particularly on the equity side, are actually using these indexes as predictive. And I think that's a really big mistake because as we saw in 2022, the Fed was much more aggressive than the market believed they were, and that led to a pretty substantial sell-off in risk assets. In this way, staying aggressive for the Fed would actually mean not cutting rates as much as the market believes, and maybe not cutting rates as much as they are indicating, giving them some wiggle room here. So I think it's just a really dangerous time to be making assumptions that rates are going to be going a whole lot lower from here, particularly with things like employment still pretty tight, wages are still rising, GDP growth is still pretty solid. If the Fed were to cut rates into those types of conditions, they could potentially risk credibility. And if they lose credibility, then they lose the market, and that would be game over for the Fed. So anyway, point is of this slide, this is the big chart for 24 that we'll have to keep an eye on. And I think the market is getting a little ahead of itself in relationship to where interest rates are going to go, which is probably why we're seeing a little bit of a sell-off here in the first few weeks of January. And then I couldn't help it but mention Bitcoin because, I'm not sure how many people actually have exposure to Bitcoin, but it is something that's capturing the zeitgeist right now in the news cycle. Turn on Bloomberg or CNBC. Not that I'm advising you do that, by the way, because those are ad selling shows. But if you turn on, Bloomberg or CNBC, then, they have, every 25 minutes or so, they have someone talking about Bitcoin ETF approvals being in the offing and what implications that's going to mean for markets and things of that nature. So short answer is, I don't believe that Bitcoin is appropriate for most or majority of investors out there at the moment. It's way too volatile for anyone to really try to grapple with unless you have an iron stomach. But it is an asset class or category that if it achieves SEC approval via an ETF, and by the way, the largest asset managers in the world are proposing Bitcoin ETFs, that being Fidelity, BlackRock, Van Eck, and others, that if the SEC approves this, then it basically legitimizes in a de facto way digital assets as an asset class that's going to be here for quite a while. So I know there's still a lot of doubts about the sector or asset class or category. And I think we're kind of moving on from that argument saying pending approval, which looks like it's going to happen, this is going to be a legitimate asset class to keep an eye on, at least as to what's going on. Not that we have to have exposure there. I still think the better way to have exposure to Bitcoin or digital assets is through private strategies. But nonetheless, it's a legitimate asset class and category, and that there will be some information being told in this prices. And we do think that this could be an asset class worth considering at some point down the road, but certainly just not yet, at least on the liquid side. But a lot of interest and activity going on around this approval process. Like I said, I think that approval process is forthcoming in the next week or so, and that would be a pretty big validation point for the whole category itself. So let's just turn to some final conclusions and takeaways. You've been very generous with your time. We're kind of at our half-hour mark here. So just to summarize what we just described here, 24 outlook, I think 23 did surprise and surpassed what we called it in January of last year, a mid-single digit expectation that was off by a magnitude of probably double. However, our positioning was not reflecting any underweighting. And this is one reason why I think it's really important to take forecasts with a little bit of a grain of salt, because our positioning, our long-term exposure to stocks has not really changed a whole lot over the last few years, because we realize that they can go kind of anywhere right now with conditions as wild as they are. But now that we're into 24 and had the year we did in 23, it does feel a little bit overbought, particularly from a valuation side, and some of these risks on the horizon around rate cuts may not be as guaranteed as some investors might think they are. To your question about concentration, I think now is a unbelievable time to be managing concentration within your equity portfolios. Certainly, we've been doing that over the course of Q4 of last year, where we're turning back some of the technology positions. Unreasonable to think that we'll achieve a similar level of outperformance in the Magnificent Seven in 24, but never say never. That is a possibility. We do want to have maybe some exposure, just more modest. And now's a great time to be, doing a little bit of risk management on those positions. We still believe bonds right now are primarily for liquidity, not necessarily for income per se, because if some great opportunities come up in the equity market, it'll be because of some sort of big dislocation or disappointment in earnings, or Fed keeping rates high when the market expects a cut. And in that way, we want to make sure we're liquid enough to make that asset allocation shift, or trimming back our bond position at very liquid bonds, to buy stocks or alternative assets when the time is right, because those will likely be the more volatile parts of the portfolio, at least in magnitude of move, not necessarily percentage terms. Still have alternative strategies remain, as a core diversification option. We had a really solid return profile for our liquid alternatives last year. No reason to think that that's not going to be the case this year, given they have very low correlation to stocks and bonds, and actually benefit from higher levels of volatility, because opportunities are always between the bid and the ask, right? So we think that's going to be a key area of diversification and benefit for us in 24, and on the back of what I think was a really great 23. And in private markets in 23, it's interesting. 23 was a bit of a mixed picture for private markets, where you had, this really long lag catch-up effect of private markets, at least on the growth side, really feeling the drawdown that happened in public markets in 22. But I think what that's doing is it's sowing the seeds for some really nice and attractive opportunities in 24 and beyond, because if you can invest at trough levels, either through private opportunities or other methods, that's a really good starting point. In private markets, of course, is not a monolith, so there's a lot of nuance between private real estate, which we think is still very much up for debate as to the direction that's headed, given the interest rate picture. Private credit is actually a really interesting and attractive asset class that looks to have some really good legs to it. And then private equity, coming on the back of some really modest or lagging performance in 23, I think just sets up for some really great unique opportunities in 24. Hope everyone had a great New Year's holiday, and we'll talk to you soon, and have a great 2024. Thanks, everybody.